Choosing a trading style is not about copying what works for someone else or chasing what looks more exciting. It is about understanding how you think, how you react under pressure, and how your daily routine actually looks in real life. Many traders fail not because their strategy is bad, but because the trading style they chose does not fit their personality, schedule, or emotional tolerance. When there's a mismatch, discipline breaks down, and consistency becomes almost impossible. Welcome back to the ComLucro channel. In this video, we focus on one of the most important decisions a trader can make: choosing the trading style that truly fits you. We will connect everything covered so far and look at how factors like time availability, patience, stress tolerance, and decision speed influence long-term results. The goal is not to label one style as better than another, but to help you make a conscious choice that you can commit to and execute consistently over time. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. The first factor to consider is your daily routine and available screen time. Scalping and day trading demand presence during specific market sessions, often for several hours, with full attention and very limited distractions. If your day is unpredictable, filled with work interruptions or personal responsibilities, these faster styles quickly become difficult to execute with discipline. In these conditions, even good setups are often missed or poorly managed. Swing trading and position trading offer more flexibility in this regard. Analysis can be done outside of active market hours, and trades develop over days or even weeks. This reduces the need for constant screen time and allows decisions to be made with more distance and structure. For traders with limited availability, slower styles often provide a more realistic path to consistency. The second major factor is personality and emotional tolerance. Faster trading styles dramatically increase decision frequency and emotional pressure. Losses and wins happen quickly, and there is very little time to mentally reset between trades. This environment suits traders who remain calm under pressure and can make rapid decisions without emotional carryover. Slower trading styles reduce emotional intensity per trade, but introduce a different challenge. Holding positions overnight or for extended periods requires patience, trust in analysis, and comfort with uncertainty and drawdowns. These styles test conviction rather than speed. Choosing a style that aligns with how you naturally handle stress and uncertainty is critical for maintaining discipline over the long term. Another important element is how you process decisions and manage mistakes. In faster trading styles, mistakes are immediately visible and often costly if not controlled quickly. There is little time to analyze emotions during the session, which means errors must be recognized and corrected almost instantly. Traders who struggle to let go of a losing trade or who hesitate after a mistake often find fast environments mentally exhausting. Slower trading styles create more space between decisions, but this does not mean they are easier. Because trades last longer, mistakes can stay open for days, which can slowly drain confidence and create doubt. Overmanaging trades, moving stops, or closing positions too early are common reactions in these styles. Discipline here is less about speed and more about trusting the original plan. Risk perception also changes significantly across styles. Scalping and day trading usually involve smaller targets and tighter stops, which can create the illusion of lower risk while increasing trade frequency. Many traders underestimate how repeated small losses can accumulate emotionally and financially. Without strict daily limits, this environment often leads to revenge trading. In swing trading and position trading, risk is experienced differently. Stops are wider, targets are larger, and patience is required to let trades play out. This can feel uncomfortable for traders who need constant feedback from the market. Understanding how you perceive and tolerate risk helps prevent choosing a style that constantly pushes you into emotional reactions instead of controlled execution. One of the most common mistakes traders make is copying the style of someone else without understanding the context behind it. Seeing a scalper trade live or a swing trader hold positions for weeks can create the illusion that results come from the strategy alone. What is often invisible is the routine, experience level, emotional tolerance, and screen time that support that style. When traders copy execution without sharing those conditions, frustration quickly follows. This problem is amplified by social media and trading content. Fast-paced trading often looks more exciting, while slower styles can appear boring or unproductive. Many traders are pulled toward styles that match what they consume, not what they can execute consistently. Over time, this leads to jumping between styles, changing rules, and never allowing one approach to fully develop. Another issue appears when traders mix styles without realizing it. Scalping with swing expectations or turning day trades into long-term holds creates rule conflicts and emotional confusion. Each trading style has its own logic, risk structure, and management rules. When those frameworks are blended without clarity, discipline erodes and decision-making becomes reactive. Consistency begins when one style is chosen and respected as a complete system. This does not mean other styles are wrong or forbidden, but that focus is required to build skill and confidence. Mastery comes from depth, not variety. Choosing one trading style and committing to it creates the foundation for structured growth and long-term improvement. Scalping fits traders who thrive under pressure, process information quickly, and can detach emotionally from individual trades. Psychologically, a scalper should be comfortable with rapid decision-making, frequent small losses, and immediate feedback without frustration. A scalper should not need long reflection time, emotional reassurance, or strong directional bias, because hesitation and overthinking quickly damage execution. From a practical standpoint, scalping requires dedicated screen time during active sessions, strong focus, and the ability to watch price closely without distractions. Day trading suits traders who prefer structure and defined boundaries. Psychologically, a day trader should be disciplined, emotionally stable within a single session, and able to stop trading once limits are reached. A day trader should not rely on impulse, revenge trading, or emotional recovery during the same day, as this leads to overtrading. In terms of time, day trading requires several uninterrupted hours during the trading session, but not constant attention throughout the entire day. Swing trading aligns with traders who are patient, analytical, and comfortable with delayed results. Psychologically, a swing trader should trust analysis, tolerate pullbacks, and remain calm while trades develop over multiple days. A swing trader should not need constant confirmation from the market or feel anxiety when not actively trading. Practically, swing trading demands far less screen time, allowing analysis outside market hours and brief check-ins during the day. Position trading is best for traders with a long-term mindset and strong emotional control. Psychologically, a position trader should be comfortable with uncertainty, wider risk parameters, and slow feedback from the market. A position trader should not be reactive to short-term noise or feel the need to intervene frequently. From a time perspective, position trading requires minimal screen time, with decisions focused on higher time frames, broader market context, and long-term structure rather than intraday movement. To bring this into practice, the most useful step is to define your trading style in writing. Choose the style that best fits your current routine, personality, and emotional tolerance, not the one you hope to grow into later. Write down how much screen time you realistically have, how often you want to make decisions, and how comfortable you are with holding risk. This process transforms a vague preference into a clear commitment. Once a style is chosen, the next step is to commit to it for a fixed period of time. A 30-day commitment is long enough to experience real market conditions, but short enough to adjust if needed. During this period, avoid switching styles, mixing rules, or comparing your results to traders using different approaches. The goal is not perfection, but consistency and honest feedback. Throughout this commitment, focus on execution quality rather than profit. Track whether you followed your rules, respected risk limits, and managed emotions according to the demands of your chosen style. Profits and losses are outcomes, but behavior is what you can control. This shift in focus reduces pressure and creates a healthier learning environment. To close, remember that no trading style guarantees success. What creates results over time is alignment between your style, your mindset, and your ability to execute consistently. When those elements work together, discipline becomes natural and improvement becomes measurable. Choosing one path and committing to it is not a limitation, but the starting point of real progress as a trader. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.